Options contracts are derivatives. They grant the holder the right to buy or sell an asset. This right is exercised at a specified strike price. Options derive their value from the underlying asset, like a stock or index. The primary attraction for traders is leverage. A small premium controls a large notional value of the asset. This leverage amplifies potential returns significantly. It also increases the speed and magnitude of potential losses.
Options contracts are derivatives. They grant the holder the right to buy or sell an asset. This right is exercised at a specified strike price. Options derive their value from the underlying asset, like a stock or index. The primary attraction for traders is leverage. A small premium controls a large notional value of the asset. This leverage amplifies potential returns significantly. It also increases the speed and magnitude of potential losses. Options are wasting assets. Their time value, called theta, decays daily. This decay accelerates rapidly as the expiration date approaches. The initial investment in a purchased option is immediately at risk. Total loss can occur solely due to this time decay. You pay the premium up front for a right that constantly loses value. Understanding this immediate risk is crucial for survival. Buying a call option grants the right to purchase the underlying asset. This purchase happens at the predetermined strike price. The buyer pays a non-refundable premium for this right. Call buyers anticipate the underlying price will rise substantially. Profit requires the price to exceed the strike price plus the premium paid. This sum defines the break-even point. If the underlying price is above the strike price at expiration, the option is in the money. In-the-money options are profitable if they exceed the break-even point. If the underlying price stays below the strike price, the option expires worthless. The maximum loss for any call buyer is strictly limited. This maximum loss equals only the premium paid. A put option grants the buyer the right to sell the underlying asset. This sale occurs at the specified strike price. The buyer pays a premium to acquire this selling right. Put buyers anticipate a significant decline in the underlying asset's price. The break-even point is the strike price minus the premium paid. Puts are used for speculating on market declines. They are also used for hedging existing long stock positions. Hedging protects against adverse price movements. If the underlying price falls below the break-even point, the put option becomes profitable. If the underlying price remains above the strike price, the option expires worthless. The maximum loss for a put buyer is also strictly limited. This loss is confined only to the premium paid. Option sellers are known legally as writers. Writers receive the premium immediately. They simultaneously assume a contractual obligation to perform. This obligation activates if the option is exercised or assigned. A call writer is obligated to sell the underlying asset at the strike price. A put writer is obligated to purchase the underlying asset at the strike price. The premium received represents the writer's maximum possible profit. Writers profit when the option expires worthless. They then keep the entire premium without further action. The risk profile for writers differs fundamentally from buyers. Writers face potential losses that far exceed the initial premium received. Option writing strategies depend on ownership of the underlying asset. Covered writing involves selling a call option while owning the corresponding shares. This ownership limits the risk significantly. The writer can deliver the shares if the option is assigned. The maximum loss in a covered call is the stock price falling to zero. This loss is offset partially by the premium received. Naked writing means selling an option without owning the underlying asset. It also means lacking any corresponding hedge position. Naked writing exposes the trader to significantly higher risk profiles. These risks are potentially catastrophic for the account balance. Brokerage firms require substantial margin deposits to cover this extreme risk. Rapid market movements can quickly deplete the required margin. This depletion triggers an immediate and mandatory margin call. Naked put writing carries substantial, though finite, risk. The maximum loss occurs if the underlying stock price falls to zero. The writer is then obligated to purchase the now worthless stock. This purchase happens at the full strike price. This potential loss is still substantial. It often exceeds the initial premium received by many multiples. Brokerage firms impose strict margin requirements for all naked positions. This ensures the writer can meet their contractual obligations. Margin requirements typically involve holding a percentage of the underlying value. This is calculated in addition to the premium received. Failure to maintain the required margin results in forced liquidation by the broker. For option buyers, the risk of total loss is the entire premium paid. This occurs if the option expires out of the money. Out of the money means the underlying price never reached the break-even point. Options held until expiration that are out of the money become worthless. This results in a 100% loss of the capital invested in that contract. The vast majority of purchased options ultimately expire worthless. Time decay, or theta, guarantees constant value erosion. Even favorable underlying movement may not be fast enough. Insufficient speed or magnitude ensures the option loses value and expires worthless.
Options trading requires specific approval levels from brokerage firms. These levels are typically 3 or 4. Approval depends on the investor's financial situation and experience. Regulatory bodies mandate that brokers assess investor suitability. This assessment happens before granting access to complex strategies. Due to high leverage, options trading is classified as a high-risk activity. The potential for catastrophic loss is significant. Investors must formally acknowledge that losses can exceed the initial investment. This is especially true for writers of naked options. Options are generally unsuitable for capital preservation goals. They are also unsuitable for investors who cannot withstand substantial financial ruin.